Good morning. Today's topic is why is a solo 401k better than a SEP IRA? Are you self-employed or running a small business and trying to figure out the smartest way to save for retirement? Chances are you've heard of both the SEP IRA and the solo 401k. But here's the big question. Which one actually gives you the most control, the most tax savings, and the most flexibility? Most people assume they are basically the same, but that assumption can cost you tens of thousands of dollars over time. We're going to delve deeper into this topic today. Also, go ahead and type over your questions during today's live webinar. We use these webinars to go over not only a daily topic, but also questions surrounding any aspect of solo 401k plans, as well as even self-directed IRAs, traditional 401ks, and even the business financing 401k. Please also subscribe to our channel so that you receive notifications when we go live. We typically go live at least once a day, oftentimes twice a day. We'll be going live again today, for example, in a few hours. So if you don't get a chance to ask your questions during this session, you can come back and join the afternoon session. You can, again, please subscribe to our channel, our YouTube channel, so that way you receive notifications as to when we go live. We also have a large video catalog there, over 900 videos there, covering all aspects of retirement accounts. You can also visit our community where we have over 30,000 members. You can post forums. You can also post your own blog post as a guest blog post and link it back to your company's website. That's especially helpful if you're an advisor or CPA or tax professional, any type of professional, and you can link back to your website so our community members can visit your site and learn more about your services. Also, take a look at our artificial intelligence page. The website for that is solo401k.ai. So solo401k.ai, and please like today's video to help get the word out to other solopreneurs like yourself. Okay, let's see here. It looks like we have a question here. Can I get the link for Form 8881? I have the link for 2025, but I need for 2024. I take it you're in the process of filing Form 8881, which is used to claim the auto contribution credit, which we're going to talk about here today. You can obtain that form by doing a search on Google. Do a search for Form 8881, and you'll be able to obtain that form from the IRS. You can download it from there. All right. So again, please go ahead and type over your questions, and we'll pause and answer those questions as they come in during the live webinar. So today's topic is, why is a solo 401k better than a SEP IRA? We'll talk about the key differences as well. So here's just some of the items that we will cover today. Why solo 401k lets you contribute more money faster, even at lower income levels. So compared to a SEP IRA, the solo 401k is more advantageous from a contribution perspective, and we will discuss that further. We're going to talk about the powerful mega backdoor Roth strategy available in a solo 401k plan, and that strategy is not available with the SEP IRA. So that's a huge difference, and that makes the solo 401k better for that main reason. And also how a solo 401k gives you access to other features like being able to take a 401k participant loan where you can borrow from the plan. You're not allowed to borrow from a SEP IRA. That's prohibited. We're also going to talk about how you can invest in alternative investments such as real estate, precious metals, cryptocurrency, notes, and so forth, using a solo 401k more easily than you can using a SEP IRA. And of course, another big factor here is the $1,500 auto contribution credit, which is only available to solo 401k plans and not SEP IRAs. Okay, let's take a look at the next slide here. So let's talk about the eligibility requirements for each. So first, the solo 401k. So in order to open a solo 401k plan, you have to be self-employed with non-owner, non-spouse, full-time W-2 employees. That translates to not employing any W-2 employees who work 1,000 hours or more in your business unless they are owners in the business, because owners can participate in the solo 401k. Or if your spouse works for the business, that's okay as well. That's known as the spousal exception. But if you hire someone who is not an owner and not a spouse in your business, and that individual works 1,000 hours or more, and any business that you control, so not just your main self-employed business, but you may have another self-employed business, you cannot employ a full-time W-2 employee who works 1,000 hours or more in any business that's under your control. That falls under the control group, affiliated service group regulations, and we've done webinars on that topic in the past. All right, let's see if we have some more questions here, and we'll get to that in a moment. But let's go ahead and talk about the SEP IRA eligibility requirements. So that's the solo 401k eligibility requirements. The SEP IRA eligibility requirement, you need to be self-employed, so you need to have a small business. That can be a big business, it can be an owner-only business, and you can have employees. So you can have W-2 employees who work 1,000 hours or more. However, with the SEP IRA, you can only make employer profit sharing contributions. And if you have W-2 employees, you're going to have to make employer profit sharing contributions to those employees as well. So you cannot discriminate with the SEP IRA either. So the difference between a solo 401k and SEP IRA from an eligibility perspective is that with the solo 401k, you cannot employ any full-time W-2 employees who work 1,000 hours or more. If you do, you cannot open a solo 401k. Whereas with the SEP, you can open a SEP IRA if you hire or employ full-time W-2 employees who work 1,000 hours or more. However, you're going to have to make sure that the business also makes profit sharing contributions to those eligible employees as well. You cannot discriminate. Okay, let's pause here and take a look at another question here. Got a question here from Being. We've never used your organization solo 401k plan before. I'm assuming you are compatible with any broker dealer and can help our clients to open up the solo K plan. Great question. As a matter of fact, the majority of our clients are institutional clients. In other words, advisors use our services for their solo 401k clients. I would say well over 90% of our business is institutional based. So yes, we can work with any broker dealer. The ones that are popular that come to mind are Schwab, Fidelity, Interactive Brokers, and even Altruist. Many institutional advisors utilize our solo 401k plan services and compliance expertise for the solo 401k plan, and the funds can be custodied at their broker dealer. And we'll actually shepherd you and the client through that entire setup process, including pre-filling out not only any brokerage forms so that they're completed, and then you just need to have your client enter their personal information and then your broker dealer information, and you can submit it through your back channel to the applicable broker dealer. And our plan is compatible with all those brokerage firms. For example, talking about Schwab, we have a lot of Schwab advisors that restate an existing solo 401k plan at Schwab for their client to our plan so that they can gain the mega backdoor Roth option, the solo 401k participant loan option, and also being able to invest in alternative investments. And we can help them open up the new Schwab brokerage accounts known as company retirement brokerage accounts at Schwab for the solo 401k that we offer, and then subsequently to help transfer that existing Schwab solo 401k, including any securities, so that they are now liquidated in kind to the new brokerage account for the solo 401k that we offer. So hopefully that answered your question. Great question. Okay, let's continue with our daily webinar here. Again, today's topic is why is a solo 401k better than a SEP IRA? And we've been talking about that already, but let's continue. In the meantime, go ahead and type over your questions during today's webinar. It doesn't have to be about today's topic. It can be surrounding any topic regarding retirement accounts, as we are well versed on all the regulations. We've been in business for over 15 years, so we've pretty much seen everything under the sun. Okay, let's see here. Let's get back to our webinar here. So we talked about the solo 401k eligibility requirements, the SEP IRA eligibility requirements. Let's talk about contribution limits and types. So again, we're trying to paint the picture here as to why a solo 401k plan is better than a SEP IRA. We get this question quite a bit, so I'm glad that we're covering this topic here today. So here's where their solo 401k really stands apart from the SEP IRA. It's got to do from the contribution perspective. So if we look at the slide here, now the overall contribution limit for tax year 2025 is $70,000 for anyone who's under age 50. Of course, there's a catch-up amount for those who are over age 50 of $7,500. And there's also a super catch-up amount of $11,250 effective for tax year 2025 and later years, resulting from the Secure Act 2.0 passage. That's known as the super catch-up contribution, and that applies to a certain age group. And we'll get more into that in a moment here. So with the solo 401k plan, because a solo 401k plan, just like a traditional 401k, is a defined contribution plan, you can make employee contributions to that solo 401k plan, as well as employer contributions. Because the solo 401k plan is not only a defined contribution plan, it's also a profit sharing plan. So it's basically two plans in one, a profit sharing and a defined contribution combined into one. And that's what makes the solo 401k so powerful. So with the solo 401k plan, you can make both employee contributions and employer profit sharing contributions. Whereas with the SEP IRA, you can only make employer, aka profit sharing contributions. You can now make employee contributions, nor can you make catch-up contributions to a SEP IRA. You can make a catch-up contribution to a traditional IRA, but not a SEP IRA. So that's an important distinction. So with the solo 401k, not only can you make employee contributions, employer contributions, as well as catch-up contributions. Whereas with the SEP IRA, you can only make employer contributions. So whether it's a solo 401k or a SEP IRA, the percentage of the employer contribution is going to be either 20% or 25% of your self-employment compensation. It's going to be 25% if it's an S corporation self-employed business. If it's a partnership or sole proprietorship self-employed business, it's going to be 20%. Now, with the solo 401k, in addition to making that employer percentage-based contribution of 20 or 25% based on your self-employed business, you can also make an employee contribution of $23,500 if we're talking about tax year 2025. For tax year 2024, that amount is $23,000. Again, employee contributions are not available in a SEP IRA. So that right there is why a solo 401k is so much more advantageous over a SEP IRA from a contribution perspective. The fact that you cannot make employee contributions to a SEP IRA. And then catch-up contributions, again, if you're age 50 or older, you can make a $7,500 contribution to a solo 401k. That's not available under a SEP IRA. There's the super catch-up contribution for those who are age 60, 61, 62, or 63 in tax year 2025. That amount is $11,250. So instead of contributing $7,500, if you fall within this age category, you can contribute $11,250. So you can't contribute both 7,500 and 11,250. You can only contribute 11,250 or less. So not both, for those who fall within that age range of 60 through 63. Again, the super catch-up is not available in a SEP IRA either. And of course, mega backdoor, the after-tax contributions, voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. That's not available in a SEP IRA. So that's another huge difference. The mega backdoor Roth solo 401k strategy, we'll talk a little bit more about that in a moment here. Okay, again, please like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our channel so that you receive notifications when we go live. Okay, let's take a look at the next slide here. So we kind of touched on this already, how business structure affects contributions. So it's more advantageous to have a self-employed business that's taxed as an S corporation, whether an S corporation or an LLC tax as an S corporation. It's more advantageous from a contribution perspective, and this is true whether it's a SEP IRA or a solo 401k. And that's because when you go to make employer profit sharing contributions, that's based on a percentage. It's not a dollar for dollar contribution calculation, it's a percentage. So if you're an S corporation, you can contribute 25% of your W-2 wages from that self-employed S corporation. On the other hand, if you're a sole proprietorship or a partnership, it's going to be 20% instead of 25% because you have to subtract 1/2 of self-employment income tax from your net self-employment income figure. So if, for example, if it's a Schedule C, if you're a sole proprietorship, the starting figure is going to be line 31. And then you have to subtract 1/2 of self-employment income tax from line 31. And then after that, you would multiply that figure by 20%. And that would be your maximum employer contribution, aka profit sharing contribution. If it's a partnership, you look at line 14, and then you subtract 1/2 of self-employment income tax from line 14, and then you multiply the difference times 20%. So that's the difference. It's typically better to have a business structured as an S corporation if you're looking to make employer profit sharing contributions. It doesn't matter whether it's a SEP IRA or a solo 401k. The mega backdoor Roth strategy. So again, a SEP IRA does not allow for the mega backdoor Roth strategy. So this is another big reason as to why a solo 401k is better than a SEP IRA. So we'll go over this example in a moment. But first, let's talk about what the mega backdoor Roth solo 401k strategy is. So the mega backdoor Roth solo 401k strategy is a way to get more Roth solo 401k funds in your plan indirectly by utilizing the mega backdoor Roth solo 401k strategy. So with the Roth solo 401k plan, while you can make both employer Roth solo 401k contributions as well as employee Roth solo 401k contributions, oftentimes that doesn't get you to the overall limit, the contribution limit for the year, which is $70,000 for tax year 2025. By utilizing the voluntary after-tax solo 401k bucket, which is part of the mega backdoor Roth strategy. So this bucket right here, voluntary after-tax, this is an example of a one participant plan where there's just one person participating in the plan. This image here is an example of a two participant plan. Let's say both spouses participate in the same plan. But let's stick with this one participant so we can continue talking about the mega backdoor Roth solo 401k strategy. So with the voluntary after-tax bucket, so with the solo 401k plan, you have separate buckets, aka bank accounts, brokerage accounts, aka holding accounts to hold your sources in the plan. You have a separate bucket to hold the pre-tax funds, a second one to hold the Roth solo 401k funds, and a third one to hold the voluntary after-tax solo 401k funds. Even though the funds will not sit very long in that voluntary after-tax bucket, you still have to have a separate bucket to make the voluntary after-tax solo 401k contributions into. Once you make that voluntary after-tax contribution to the voluntary after-tax solo 401k brokerage account or bank account, then that gets converted immediately so that there are minimal gains. That gets converted immediately to the Roth solo 401k. That way, if there are any gains and those gains get converted, you're going to pay minimal taxes because just the gains will be taxable, not the basis. So the basis would be the contribution amount. And the reason you have to have separate brokerage accounts, bank accounts under a solo 401k plan is that it's a defined contribution plan, and the regulations require separate tracking for each source of funds. And that's done by having separate, and that's accomplished by having separate holding accounts. Same thing if you have two spouses participating in the same self-employed business, the plan will be sponsored by the self-employed business. So let's say you both work under the same S corporation, it would just be one plan because the plan is sponsored by the business. And then if you both work under that same S corporation, you're each going to have three separate holding accounts, aka bank or brokerage accounts, to hold your contribution amounts, whether it's pre-tax, Roth, and voluntary after tax or voluntary after tax. So this example here, you see a total of 6 brokerage accounts, 3 for each participant because they're both working under the same business. So it's just one plan. So you can each utilize the mega backdoor Roth strategy as well. Now, just because the plan allows for all these different sources of funds, you don't have to open up all these brokerage accounts right away or bank accounts if you're not planning to make these various contribution types. If you only plan to make 1 or 2 contribution types, the plan will still allow you to later open up that other brokerage account. But most people have the bank accounts or brokerage accounts opened up at once. And again, it's considered just one plan. It's not considered 3 different plans or 6 different plans. So back to the example of the mega backdoor Roth strategy. So here's an example of, let's say you've got Thomas, who's self-employed in his own self-employed S corporation. He's looking to maximize contributions for tax year 2025 to his solo 401k plan. He wants to do some contributions, both employee, employer, and then he wants to also utilize the voluntary after-tax solo 401k contribution as part of the mega backdoor Roth strategy. So let's say that Thomas makes a $23,500 employee contribution to this Roth solo 401k. So that goes into this bucket right here, the Roth bucket. And then he decides to make an employer contribution, which is 25% of his W-2 wages. So let's say he makes $70,000 in W-2 wages. You would multiply that 70,000 by 25%, which is what? Let's see here, 70,000. Use my calculator here. That's going to be $17,500. So if he decides to make that employer contribution as a pre-tax contribution, that's going to go into the pre-tax bucket. And that's where it'll flow into. And then Thomas decides that he wants to make the difference as a voluntary after-tax solo 401k contribution. So we add up 23,500 of employee contributions plus $17,500 of employer profit sharing contributions. That's a total of $41,000. he can contribute the remainder up to $70,000 as a voluntary after-tax solo 401k contribution. So let's subtract 41,000 from 70,000. That's $29,000. So that $29,000 difference, Thomas would deposit that into the voluntary after-tax solo 401k bucket here, and then immediately convert it to the Roth solo 401k. So that's how he would be able to maximize his contribution to the plan by just solely paying himself $70,000 of W-2 wages from his self-employed S corporation. Whereas with the SEP IRA, you would only be able to contribute 25% of 70,000. So that, I think it was 17,500 is what we came up with. So that's a big difference because again, the SEP IRA does not allow for employee contributions, and it does not allow for voluntary after-tax solo 401k contributions. So that's a good illustration as to why the SEP IRA doesn't live up to the solo 401k standards from a contribution perspective. Another advantage of a solo 401k over the SEP IRA is that a SEP IRA does not allow for 401k participant loans. That's where you borrow from your solo 401k plan. So a SEP IRA does not allow you to borrow from it. If you borrow from a SEP IRA, that's going to be considered a taxable distribution immediately. But with the solo 401k, you can borrow 50% of your total solo 401k balance, not to exceed $50,000. So if the balance of your solo 401k is $80,000, for example, the maximum you can borrow is $40,000. On the other hand, if the balance of your solo 401k is over $100,000, then the maximum you can borrow would be $50,000. Now, what's great about the solo 401k is that each participant can borrow from the solo 401k plan. So again, using this example earlier, where let's say you are self-employed in an S corporation, you and your spouse both work for the same business, you and your spouse both transfer, let's say, former employer plans and or IRA funds to the pre-tax solo 401k, you can each borrow from your respective solo 401k, 50% of your respective solo 401k balance. So if you each have enough funds in your solo 401k plan, then you can each borrow up to $50,000 for a total of $100,000. And you can use those loan proceeds however you wish. And there's no credit check when you borrow from your solo 401k plan. You pay back your own plan. It's typically the prime rate plus 1%, or you can use a competitive CD rate plus 2%. Payments are scheduled monthly, quarterly, typically over a 5-year period. So they're fixed payments. You make them monthly or quarterly over that 5-year period. There's an exception if you use the borrowed proceeds towards the purchase of your primary residence, then that loan can be extended to 15 or even 30 years. And when you borrow from the solo 401k plan, you can use the funds for any purpose. And again, there's no credit check for that either. And when you borrow from the plan, you have to make sure that the proper loan documents are prepared. Here at my solo 401k financial, we offer a plan that does allow for 401k participant loans, and we'll draft those 401k participant loan documents at no additional cost, nor do we charge you an extra fee for having a loan feature on your plan. A lot of solo 401k providers out there do charge additional fees, not here at my solo 401k financial. And you have to have a loan payment amortization schedule prepared and certain loan documents. You can't just use a paper towel or an envelope as to drop the loan documents. You got to have specific loan documents with specific IRS language, and we draft those as well. So those are another reason why the solo 401k is better than the SEP IRA. Okay, so we just answered this question, it looks like, from Rachel by going over this slide here regarding the solo 401k participant loan rules. Let me send over a link that talks more about the solo 401k loan regulations as well. We did a separate webinar on that topic as well because it's a very popular option, especially now. So take a look at that link there. Okay, again, please like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our channel. Please also visit our community. It's free to join. You can post forums. We have over 30,000 members there. You can also post guest blog posts. Take a look at our artificial intelligence page, which is the website address for that is solo401k.ai. So www.solo401k.ai. All right, let's keep going over today's topic here, which is why is a solo 401k better than a SEP IRA? So we talked about the loan feature. Another reason why a solo 401k is better is because it allows for alternative investments to be placed much more easily. Yes, you can open up a self-directed SEP IRA that allows for investing in alternative investments. When we talk about alternative investments, we're talking about physical real estate, farmland, cryptocurrency, precious metals, whether gold or silver, private equity, real estate syndicates, promissory notes, whether secured or unsecured, tax liens, the list goes on. And you can also invest in equities through the solo 401k plan as well. So it's one-stop shop. Not only can you invest in alternative investments, but also equities like stocks, exchange traded funds, and so forth. With the SEP IRA, you're going to have a checkbook IRA LLC if you really want to be able to have full control, aka checkbook control, for investing in alternative investments. With the solo 401k, you already have checkbook control, aka wire control. You'll be able to place those alternative investments by wire or by writing a check. You don't have to have a checkbook or an LLC in order to place those investments. So that's one of the major differences between a solo 401k and a SEP IRA is that you don't have to have a checkbook LLC in order to place alternative investments because the solo 401k comes with checkbook control, wire control already. Tax credits. This is a huge difference of why a solo 401k is better. So a SEP IRA does not allow for the auto contribution credit, whereas a solo 401k plan does. What's the auto contribution credit? Well, it's a dollar for dollar tax credit equal to $500 per year for a maximum of $1,500 over 3 years. So for example, if you open a solo 401k plan here in 2025, we'll draft those plan documents to allow for the auto contribution credit. And what's great about the auto contribution credit is that you are not required to make contributions in order to qualify for that $500 yearly credit over a 3-year period and for a total of $1,500. So if you open a solo 401k plan in 2025, or let's say you have an existing solo 401k plan at Fidelity or Schwab, you can restate that plan to our plan and we'll add that auto contribution feature to your plan so that you qualify for it here in 2025. And then you would be able to qualify again in 2026 and in 2027. So $500 per year for 3 consecutive years. Now, it's important to understand that not all solo 401k plans have the auto contribution credit available. A plan for my solo 401k financial does. The Schwabs and Fidelities of the world do not. Now, again, if you open a solo 401k plan with my solo 401k financial, we'll automatically drop those documents to allow for it. It can also be added to existing plans. Let's say you open the solo 401k plan with my solo 401k financial prior to December 31st of 2024. That's when the credit first became available, was January 1st of 2024 and after. Excuse me. Let me rephrase that. If you open the solo 401k plan with my solo 401k financial prior to December 31st of 2023, we can add that feature to your plan. That feature was not available till January 1st of 2024 and after. So existing clients would qualify. We would need to amend your plan to add that credit if you opened your plan with this prior to December 31st of tax year 2023. Now, talking more about the auto contribution credit. So it's a dollar for dollar credit. So if you're looking to open a solo 401k plan for the first time, this auto contribution credit is going to cover the cost of having a solo 401k plan for many years. So again, the $1,500 auto contribution credit is easily going to cover the cost of having a solo 401k plan for many years. And it's a dollar for dollar credit. So it reduces your business taxes dollar for dollar. And you're going to use Form 8881 to claim that credit. It's Form 8881. It's a 2-page form. You attach that to your business tax return each year. So you would file that Form 8881 each year. So one for 2025, which would be filed next year, it's for $500. You would file a second Form 8881 for tax year 2026 for $500, and a final one for 2027 for $500. Your question, does our service include filing? No, we don't file Form 8881. You would file that with your business taxes, and it's only a 2-page form. We do provide, however, a PowerPoint presentation and a video that we can share with you that walks you step by step on how to file it. So if you submit a support ticket or send us an email, we'll send you those PowerPoint slides and the video. It's only a 2-page form. So there's only a small section that has to be filled out. All right, great question. So we've gone over why a solo 401k is better than a SEP IRA. We've come to the end of our session today. We appreciate you joining and asking questions. We'll be live again here in a few hours if you did not get a chance to ask your questions. Until next time, have a great rest of the day.